Okay, let's dive in. We are unpacking the Q1 fiscal year 2026 earnings call for Costco. You know, the retailer that basically made bulk buying a way of life for millions.
That's right. And this deep dive covers the 12 weeks that ended back on November 23rd.
So our mission here is pretty clear. We want to understand the core strength of Costco's flywheel, really scrutinize some of the headwinds that kept the stock, well, fat.
And synthesize what is a truly massive bet on the future. A $6.5 billion capital expenditure plan.
Yeah, that $6.5 billion number, it just hangs over this entire story. Because on the surface, the results were, they were outstanding.
They were.
But the market reacted with total indifference. It's like finding a great deal on something you already have three of.
It's a classic case of a great quarter, but not enough. And it's all tied to that forward-looking tension. So let's just run through the snapshot.
Okay.
Costco delivered a really clear top and bottom line beat. The GAAP earnings per share came in at $4.50.
And the consensus was what, around $4.27?
$4.27, yeah. So a very clear beat. And for everyone listening, when we say GAAP EPS, we're just talking about that standardized headline profitability number.
The one everyone sees first.
Exactly. Revenue also held up great. It hit $67.31 billion, which is up 8.3% year over year, right in line with what the street was expecting.
And the operational strength behind that number was really robust, global comparable sales, strong at plus 6.4%. And what I love about this is how it breaks down. It was almost perfectly balanced. Traffic was up 3.1% and the average ticket was up 3.2%.
So you're not seeing inflation just masking weakness.
No, not at all. You're seeing more people walking in the door and buying more stuff. It's real growth.
And if you want to talk about momentum, their digital engine is just running hot.
Yeah.
Digitally enabled comps surged 20.5%.
20%. With all of that strong traffic, strong ticket, surging digital, you'd expect the stock to, pop.
You would. But instead, we just got a collective shrug from the market. There was a little after-hours bump, about 1.15%, but it completely faded.
And the next day, it closed basically flat. The market is screaming, we believe you're good, but prove to us you're worth this really high valuation going forward.
And that skepticism, it starts the moment you dissect that headline EPS number. Remember the $4.50?
Yeah.
Well, management disclosed that it included a discrete tax benefit of 16 cents per share.
Ah, okay. And that was tied to stock-based compensation, right? Not the core business.
Exactly. So if you strip out that one-time accounting item, the implied EPS drops to about $4.34.
Which is still a beat over the $4.27 consensus.
It is, but it's a much less impressive beat. That 16 cents, it really matters when you're chasing momentum. It just takes the shine off the headline number.
It absolutely does. Okay, so let's talk about gross margins, because this is where the operational story is just, it's phenomenal.
It really is. With all the cost pressures out there, their gross margin rate was actually higher by 4 basis points year over year, hitting 11.32%.
And just a quick clarification, a basis point, or BPS, is just 1/100 of 1%, so 4 BPS might sound tiny.
But on a revenue base of $67 billion, it is a massive amount of money.
Right.
And get this, the core margins, so the margins on the actual stuff they sell, were up 30 basis points.
30. So what's driving that?
Management pointed to 3 things. First, better supply chain efficiency. Second was increased marketing revenue. And third, and this is a big one, higher penetration of Kirkland Signature.
Kirkland Signature. Let's stay on that for a second. Why does selling more of their own brand help the margins so much?
Well, it's really 2 things. First, they have total control over the sourcing, so they control the costs better.
Okay.
But second, they capture the entire vertical margin. They can sell a Kirkland product for, say, 15 to 20% less than a national brand and still make a higher margin on it.
Wow.
So every time you, the customer, choose the KS bacon or the KS walnuts, you're actually strengthening Costco's entire financial structure.
So it's a win for the customer on price and a win for the company on profit. That's the flywheel right there.
That is the flywheel. And their ancillary businesses help too. Things like the pharmacy and hearing aids, they added another 7 basis points to the margin.
And those are so important because they lock people into the membership, right? You have to be a member to use the pharmacy.
Exactly. It reinforces the whole value proposition.
Okay, so huge gains on the margin side. But then on the expense side, the SG&A, they basically gave it all back. What happened there?
Yeah, SG&A leverage was pretty much neutralized by 2 big factors. First, and this was the big one, higher healthcare costs that just grew faster than sales.
A common story right now.
Very common. And second was a one-time charge, about 4 basis points related to a tax assessment from a prior year.
So regulatory stuff.
But here's the really critical part, the balancing act. Management said that their productivity gains from tech investments. They completely offset the cost of wage hikes and longer store hours.
So they invested in their people and in tech, and the tech was so effective it paid for the people.
That's it. It's an incredible display of execution. Think about their pre-scan technology that's making checkout up to 20% faster. That's a direct productivity win that funds wage increases.
That is just, it speaks volumes about their focus. But okay, let's shift gears to the real engine of the whole company, the membership fees.
The pure profit center.
Exactly. It generated $1.329 billion. That's up a fantastic 14% year over year.
The engine is definitely roaring. Total paid members hit 81.4 million. And the really profitable ones, the executive members, they grew over 9% to almost 40 million.
Highest quality revenue you can get.
The highest.
And yet, despite all that growth, we hit the friction point, the thing the market really zeroed in on. The renewal rates, a slight dip, a tiny dip, 10 basis points quarter over quarter. So why is a 0.1% decline causing so much anxiety for investors?
Because that membership fee is the bedrock of the entire business. Any sign of erosion there, even a hint, is an immediate red flag.
So what was management's explanation?
They called it a mix shift. Basically, as more people sign up online, the overall pool of members starts to change.
Okay, so help me translate mix shift. Are we talking about lower quality members signing up online? Why are they less loyal?
It's more about their intent. Management's theory is that this online group is often younger. Maybe they sign up for a specific Black Friday deal or a TV.
So it's more transactional for them.
Exactly. It's less of a core weekly grocery commitment like the family that signs up in the store. So they renew at a slightly lower rate.
That is such a key distinction. So their success in driving digital app traffic up 48%, website up 24%, is simultaneously creating a small drag on their single most important metric.
It's a paradox. And management didn't hide from it. They said they're working to mitigate it with targeted emails to expiring members.
Okay.
Which helped the decline be less than anticipated. But they still warned that the rate might see a slight drift down over the next few quarters.
And the market heard that warning loud and clear.
Oh yeah, it's an explicit trade-off. More digital growth now for maybe a tiny bit less loyalty later.
And speaking of digital, their delivery partners, Instacart, Uber Eats, they're actually growing sales even faster than Costco's own digital channels.
Which is a crucial insight. It shows how they're leveraging technology and partners. They aren't just chasing buzzwords. They're using AI for real, tangible value.
Can you give us a concrete example of that?
The best one they gave was AI in their pharmacy inventory management.
Okay.
The system has helped them get to over 98% in-stock rates. And the result? Mid-teen growth in scripts filled. Better inventory leads to better service, which drives more sales. It's a powerful cycle.
And they're rolling that out for gas inventory now too, right?
They are. It's all about using tech to hammer home their core position as the price leader.
Which brings us to the centerpiece of this whole story, that $6.5 billion Capex guide.
It's a massive number. That money is for new warehouses, remodels, depots, and of course all those digital systems we were just talking about.
$6.5 billion. I mean, the question you have to ask is, does the payoff justify that massive upfront risk?
Well, the plan relies on accelerating their physical footprint. Their long-term goal is still 30-plus new stores a year, though they did revise this year down little to 28 because of delays.
And they're getting pretty creative with the real estate to hit those numbers, aren't they?
Absolutely. They're doing conversions, turning old stores in France or refurbished home improvement stores in Canada into Costco's. It's faster, it's cheaper, and it lowers the risk.
And it seems to be working. The new warehouses are maturing faster than ever.
They are. The stores they opened in FY25 are on track to do $192 million in sales in their first year. 2 years ago, that number was $150 million.
That's a huge jump. It shows the brand is just getting stronger.
It absolutely does. But it all comes back to that core principle for them. Price leadership. They were spending all this money, but they promised to be the last to raise prices and the first to lower them.
And we saw that with how they're handling things like tariffs.
It's exactly. Shifting production, sourcing more from the U.S., anything to protect that final price for the customer.
And of course, Kirkland Signature is a huge part of that.
A huge part. Management even gave specific examples of recent price decreases on Kirkland items. Chicken pot pie, bacon, walnuts. They are actively fighting inflation for their members.
And just to wrap on the demand picture, they threw out some amazing stats. 100,000 pizzas on Halloween.
4.5 million pies before Thanksgiving.
And over $250 million in e-commerce orders on Black Friday. I mean, the demand is just undeniably there.
It is. So let's connect all this back to the investor. The bullish case is rock solid. They're gaining market share everywhere. Operations are incredibly productive. The value prop is ironclad.
So if execution is nearly perfect, why did the stock stall?
It's that valuation tension. The stock was already priced for perfection. So the market is now laser focused on those two little red flags we talked about.
Okay, so first is that slight drift in the renewal rate.
Right. Investors are starting to question the long-term quality of this new digitally acquired member.
And second is the sheer size of that $6.5 billion Capex plan.
Exactly. The market wants proof that it's going to generate immediate returns without just crushing their free cash flow in the short term. It's execution risk.
So the big catalysts ahead are seeing that renewal rate stabilize and getting clear evidence of ROI on that massive spend.
Yep. And we'll get our first look at momentum with their next monthly sales report on January 7th.
Okay. As always, before we get to our trade idea, we have to be crystal clear. This next segment is for informational and entertainment purposes only.
This is not financial advice. Please always consult a licensed financial professional before making any investment decisions.
Absolutely. But with that said, if we use the market's own reaction as our guide, the trade thesis is based entirely on that flat stock price.
That flatness, it signals exhaustion. It shows the market is not willing to pay a premium for growth that isn't 100% confirmed.
It's demanding certainty on member quality and capital efficiency, especially when the company itself is guiding towards a small dip in its most important metric.
So the outrageous but plausible trade idea is this. Long-term puts on cost, maybe targeting an expiry about 6 months out.
So you're betting against the stock breaking higher.
We're betting that it consolidates or drifts lower until two things happen. That renewal rate stabilizes and management shows clear, unambiguous ROI on that $6.5 billion. We're using the muted reaction as a signal that the upward momentum has stalled. For now.
A fascinating take. It's a bet on the time lag required to prove out the strategy, not a bet on the failure of the company itself.
That's the analysis. The skepticism is already baked in.
Okay, so to recap our deep dive, Costco delivered a really strong operational quarter. The value proposition is as strong as ever. Digital growth is exploding.
But market skepticism is focused on two things. That slight drift in membership quality from the new digital cohort and the huge execution risk of a $6.5 billion investment plan.
It really forces you to ask a final provocative question, doesn't it?
It does.
Given that management is explicitly focusing all this tech investment AI in the pharmacy, AI at the gas pump, on driving efficiency so they can lower prices, how can any traditional retailer compete?
When they're all having to raise prices just to afford the technology in the first place.
Exactly. That is a question for you to think about as you connect these details to your own investment playbook. Remember our disclaimer. This is for informational purposes only. We appreciate you diving deep with us.
We'll catch you next time.